Welcome to the deep dive. We spent a lot of time here talking numbers, strategies, charts, but today we're actually shifting focus a bit. We're going to dive into something, well, maybe even more fundamental. It's something that often separates the really successful investors from those who seem to struggle more, your emotions.
It's huge.
Yeah, we've got a whole stack of insights here, and our mission today is really to unpack how our own psychology, how it can be our greatest asset, or honestly, our biggest liability in the markets.
Absolutely.
We're going to tackle two specific emotional pitfalls. You might even call them cognitive biases.
Yeah, bias is a play for sure.
The fear of missing out, FOMO, everyone knows that one, and that sheer terror that leads to panic selling.
Two big ones. Really common.
Okay, let's jump right into FOMO then. You know the feeling, right?
Oh, yeah.
It's that buzz. You hear about that one stock. It's just soaring.
Everyone's talking about it.
Your friend, coworker, someone on social media. They all bought in last month, made a killing.
And you didn't.
And you're sitting there thinking, did I miss the rocket ship again?
Mm-hmm. That left out feeling.
Yeah. And suddenly there's this intense pressure. It's almost magnetic to just jump in.
Logic kind of goes out the window.
Totally. You're just thinking, I have to get in now or I'll miss my chance forever.
That classic FOMO trap.
It really is textbook herd mentality, right?
Yeah.
Pushing you to buy high, often right near the peak.
Which is, let's be honest, often a recipe for disaster.
Exactly. But why are we so susceptible to it?
Well, it's fascinating, isn't it? How universal that feeling is. But the key to countering FOMO, to really beating it, it boils down to perspective.
Perspective, okay.
Yeah, think about it like this. The stock market isn't a single event. It's not like missing one train,
Right, there will be others.
Exactly. It's this continuous landscape of opportunities. And here's the thing people often forget. By the time a stock is a hot topic everywhere, at dinner parties, all over your social feeds, a big chunk of the initial, really substantial gains, it's often already happened.
So the easy money, quote unquote, might already be gone.
Often, yes. Behavioral finance research shows this again and again. Retail investors, driven by that herd instinct, they tend to jump in after those bigger initial gains.
Which leads to underperforming.
Right, compared to someone who has a disciplined long-term strategy. The real strength isn't chasing trends. It's sticking to your own plan, your own research.
That makes so much sense. We get caught up in the immediate story, forget the bigger picture. Okay, so if chasing the high is one trap, then running from the low, that's its equally destructive sibling, isn't it?
Absolutely.
Let's talk about that gut-wrenching feeling when the market just tanks.
Yeah.
Your portfolio is suddenly very, very red. News headlines are screaming, recession, crash, crisis.
It feels like the sky is falling.
It really does. Your stomach just drops and you feel this primal urge almost to just sell everything.
Just make it stop. Stop the bleeding.
Yeah, make the pain go away.
That impulse, what we call panic selling.
Yeah.
It's often the single most destructive thing an investor can do.
The single most destructive.
Yeah.
Wow.
Yeah. It taps into something called loss aversion. Behavioral economics talks about this a lot. Our brains are basically wired to feel the pain of a loss much, much more intensely than the pleasure of an equivalent gain.
Okay, I can see that. Losses feel worse.
They really do.
Yeah.
So selling feels like the rational escape route in that moment of panic.
But it's not.
It's frequently the most irrational move.
Yeah.
And here's the crucial part. A loss isn't actually real until you sell.
Ah, okay. It's just on paper until then.
Exactly. When you panic sell, you're not stopping the bleeding. You are literally locking in that loss. You make it permanent.
You take yourself out of the game for the recovery.
Precisely. You guarantee you won't be there for the inevitable recovery. And history is just full of examples. The Great Depression, 2008, the COVID crash. Markets have always recovered from every major downturn. Always.
Eventually reaching new highs, right.
Eventually, yes. By selling when you panic, you turn that temporary paper loss into a permanent real one. You miss the rebound.
It's fascinating how our own survival instincts can kind of backfire in the market.
Designed for escaping lions, not market dips.
Right. That primal urge to sell. I mean, we've all felt that pit in our stomach, haven't we?
Absolutely.
But really resisting that urge when it feels like the world is ending, how do you actually train for that? It's more than just knowing it intellectually.
That's the key question. Knowing isn't the same as doing, especially under pressure.
So for our listener, how do we translate these insights, these warnings, into practical strategies? What can you actually do?
Okay, yeah, let's get practical. There are really three foundational steps that can make a huge difference in building that emotional resilience.
Okay, 3 steps.
First, create a plan and stick to it. This is vital. Decide on your asset allocation.
Okay, like how much in stocks, bonds, that sort of thing.
Exactly. How you strategically divide things up. Figure out your personal risk tolerance. How much volatility can you genuinely stomach? And define your long-term goals. Critically, you need to do this before the market gets emotional. When things get turbulent, that preset plan, that's your anchor.
Your rational North Star, you called it.
Yeah. It stops you from making those sudden, fear-driven moves, like dumping everything into cash, because your plan already accounted for some bumps.
Okay, plan first. Got it. What's number 2?
Second, audit your investments. This is incredibly powerful. Set up automatic, regular contributions.
Like into index funds or retirement accounts?
Perfect examples. Broad market index funds give you massive diversification, hundreds, thousands of companies. Retirement accounts obviously have long-term benefits. The beauty of automation is it removes emotion completely.
Yeah.
You just buy consistently. Market's up, you buy. Market's down, you buy.
Dollar cost averaging without even thinking about it.
Exactly. You take the decision-making, the emotion, out of the loop.
Simple but effective. Okay, number 3.
Third, and this is a simple visual, but it's incredibly powerful. Zoom out. Seriously. Go find a long-term chart of something like the S&P 500.
Yeah.
Look at decades of data.
Okay.
What you'll see is decades of pretty consistent upward growth. Yes, there are dips, big ones sometimes.
Like 2008, 2020.
Right. But on that long-term chart, they look like temporary blips, speed bumps on a long upward journey.
Perspective again.
Exactly. It's a powerful visual reminder that downturns are normal. They're part of the cycle. They aren't the end times.
Actually, opportunities.
They absolutely are. Opportunities to buy good assets at a discount, if your plan allows for it.
Plan, automate, zoom out, okay? That feels manageable. So ultimately, these emotions, FOMO, panic, they're like this force of nature, aren't they? So powerful, so ingrained.
They really are.
But understanding them, knowing where they come from, it means you don't have to let them steer the ship, right? You don't have to let them dictate your financial future.
That's the core message. You have the tools to navigate them.
You can manage them.
Exactly. By understanding the psychology, the why behind FOMO and panic selling, and by building that disciplined, ideally automated plan, you gain the clarity, the resolve you need to weather pretty much any market storm and stay firmly on that path to financial freedom.
Makes sense. Build the lifeboat before the story hits.
Couldn't have said it better. Which, it raises an interesting final thought for you, our listener. If navigating something as wild as the stock market hinges so much on our emotional discipline, on having a plan before we react, what other big areas of life could genuinely benefit from that same approach, from understanding our knee-jerk reactions and managing them proactively?
That's a really good question to chew on, something to consider.